Why is central bank credibility essential for fighting inflation? Imagine trying to steer a boat through choppy waters without knowing if the captain will keep the course. That's what it's like for a central bank trying to control inflation without credibility. When people trust that the central bank will do what it says, it shapes their expectations about prices in the future. If everyone believes inflation will stay low, they won't rush to buy things or demand higher wages. This helps keep prices stable. But if trust is weak, people might expect prices to rise, and that can make inflation worse. Inflation expectations are like a self-fulfilling prophecy. If workers expect higher prices, they ask for bigger wages. Businesses then raise their prices to cover higher wages. This cycle can spiral out of control if the central bank is not seen as reliable. When a central bank has credibility, it can keep inflation expectations anchored. That means even if there is a sudden spike in oil prices or supply chain issues, people believe the central bank will act to bring inflation back down. So, short-term shocks don't cause long-lasting inflation increases. On the other hand, if the public doubts the central bank's ability or willingness to fight inflation, even a small shock can lead to higher inflation expectations. For example, if the central bank raises interest rates to slow inflation but people think it won't stick to its plan, they might start demanding higher wages anyway. That makes inflation harder to control and often requires more aggressive policies. These policies can slow down the economy and cause other problems. Central banks build trust by consistently hitting their inflation targets over time. They do this through clear communication about their goals and how they plan to reach them. Being open about successes and failures also helps. If they miss their targets, explaining why and what they will do next keeps the public confident. Many central banks use inflation targeting, where they set a specific inflation rate as their goal. When they meet this target regularly, their credibility grows. Historical examples show that central banks with strong credibility can manage inflation with smaller changes in interest rates. During the high inflation period of the 1970s, many central banks struggled because they lacked trust. Later, when they gained credibility, they could guide inflation expectations more effectively. This made controlling inflation less painful for the economy. In the end, credibility is like a shield that protects the economy from inflation's worst effects. It allows the central bank to influence what people expect about prices, which in turn influences actual inflation. Building this trust takes time, consistent actions, and honest communication. When a central bank is credible, it can respond to shocks more smoothly and keep inflation stable, helping everyone plan for a better financial future.